Alrighty, so we're going to go ahead and get started. So tonight we're going to be talking about financial management and residency. Congrats to you guys. I know some of you all were at AMEC and there were quite a few business talks, investment talks. I was definitely on those workshops. So as most of you guys know, I'm a third-year resident at Lawrence Family Medicine Residency. I have one of my fellow co-residents on, as well as one of our associates program directors. Tina, you want to introduce yourself and your partner?
Sure. Hi, everyone. First of all, congratulations. I hope everyone is relaxing and enjoying themselves. Um, and I'm Tina. I'm a second year resident here at Lawrence. Um, this is my husband Andy. We are from Texas, and really excited that Ryan let us come on and meet y'all and just be excited with y'all.
So they'll be giving us some input for people that have partners in balancing finances. And then some of you all may remember Dr. Karen Marshall. She's one of our associate program directors. Um, I know she's on the phone, but are
I'm,
you able to say?
I'm here. Yeah.
Okay, great.
Hi. So hi, I'm Kara Marshall. I think I was on once before, so I met some of you all. And like Tina said, congratulations. I hope you guys, it's spring and you guys are planning and taking the next steps. And that's great and amazing. And I hope you're really enjoying it. Um, and I also am hoping that things are getting better for everyone out there with being able to do a little bit more and have the effects of COVID go down just a little bit. And really hoping that you guys' training will be much less impacted by COVID than what the last couple of years has been.
Definitely. Thanks. So as everyone has already said, congrats, you have a job. Now we got to manage that money. So I just want to always preface that we're not financial advisors or experts. We're just kind of sharing from our experience so that we can share the knowledge. So this is just kind of like a page of all the things I think I felt that were important or were like considered basics. Tina, I'm gonna ask you if you could kind of like manage the chat room. Would that be okay? Perfect, thanks. And so as always, feel free to kind of like ask questions in between. We'll also have some time to ask questions afterwards. So the first thing that I think is important to start with is a budget. Sometimes having a budget is hard. And there are different ways that you can go about having a budget. So I know a lot of people like to use apps. So there's like Mint, there's Personal Capital. I'm sure there's other ones out there, but those were the two that I was most familiar with. Do either of you all use any other apps to keep budgets? I know that there are some banks that have like internalized budget keepers. I some have like honestly felt more comfortable with just keeping my own like Excel sheet. And it's not great because I don't budget everything. I don't know where all my money goes. So I'm not the greatest budgeter, but I budget based on fixed costs. And I just don't know where all the variable costs go. So I'll talk a little bit about that because I did put some snapshots of my own budget so that you guys can see an actual example. So that's the first thing. So the first thing is you really want to know where your money is going. If you don't have a plan for your money will disappear without you knowing where it went. And then, so you have to kind of determine what your budget is going to look like. Of course, if you have a partner, if you all are doing finances together or not, that is another thing to maybe consider. I personally, my husband and I, we do our finances separate, but we like basically split on like all our common things. So different people do different things in different relationships, but it's something to consider. So making sure that you consider your partners in your budget. And then one thing that I will say is like when you determine your budget, most of your income really is going to go to housing for the most part. So, most people spend between 30 to 40% of their earnings on rent or housing of some sort. So that's one aspect. And then the next thing that will probably happen is your loan repayment. And then the other aspect, of course, is like food and utilities. But I think something that's really important is that you pay yourself first. And what I mean by that is, with your savings and investments, and making it fixed so it's automated, so you don't have to think about it. So as it relates to saving, I think everyone really talks about emergency fund. I like to call it like financial freedom fund. Like, if something hits the fan, I will have a backup. And people will ask, like, how much should I have in my emergency fund? That depends. Some people will say you should at least have $1,000. But it just depends on what your emergency fund's purpose is. So you were gonna say something, Kara?
No, I was just going to say, and it depends on where you are in your life too. I think over time, a lot of financial advisors will say that your goal that you're trying to get to is having at least like 3 to 6 months of income that you have in your kind of financial freedom or your freedom fund, because that's whatever happens that's awful out there, then you have some cushion, and because you're going to be making money, but you want to, anything can happen, horrible things, accidents, all of those things can happen. You want to make sure that you have reserves and that you're not going to, lose your house or lose things that are really important to you if something happens to your income, whether that's because you get sick, disability, all of those things. You want to have a cushion that makes you feel safe. And that's hard to do when you build it up. Obviously, you build that up over time. It's not like you can't take your first 6 months of salary and slap it in the savings funds. But it's something to work towards and something to think about. And the other thing that I'd say too is, like, you're in a transition period right now. And I know, for a lot of people, you're about to get a bigger paycheck than you've ever seen in your life, right? And it's really easy to think, oh my gosh, I'm going to be making so much money, which it is. It's true. I mean, doctors are well compensated. There's not anything to complain about with that. However, if you having that kind of mindset, it can be really easy to think, oh, I really don't have to think about money that much because I'm good now, right? And I think that's something that we automatically kind of do in our heads, okay, well, maybe my parents had to think more about money. I'm all of a sudden making this doctor's salary. I don't have to think about this that much anymore. And that can be a mistake because, yeah, you're well compensated, but you're not Tiger Woods. You can't be buying a whole bunch of Ferraris. And I know you're not planning on doing that, but the little things will add up. And it is a reasonable amount, but it's not endless. And you have to think about where it wants to go, where you want your money to go, and think about what your priorities are. Because if you don't think and you don't plan, then you'll end up not doing the things like putting it in a savings fund. You'll end up with building up things on your credit card that you don't really want there, with debt. And if you don't have a plan and you don't think ahead, you won't be making enough money to carry yourself through. So just thinking and planning ahead for, okay, yeah, this is more than I've had before, but I still have to be thoughtful about what my priorities are and how to make my money go where my priorities are. Because if you don't pay attention to it, it's going to go elsewhere than where those priorities are. That's what we're all human, and we all see, we all click on whatever, late at night and you end up buying things or making decisions that you're not really planning on if you don't have a plan for yourself. And I guess the only other thing, and I'll be quiet because I wasn't intending to talk this much.
No, go ahead.
Is that, and having that discussion, if you have a partner, really having a discussion about what priorities are, particularly if you do have your finances together. If you have them primarily separately, then okay, what are the things that we're going to plan for together? Vacations, what are the things are we saving for together, and how can we make our priorities match up? And if you are putting everything in the same pool, like I do with my spouse, then we have, every month we go through a budget and talk about, okay, what's the next thing that's our priority for the next thing we want to have done on our house is this, and that's going to be the next thing we'll save money for. And how do we prioritize for that? And if you're intentional about it, then it works a lot better to have your money going where you want it to go, and not ending up at the end of the month being like, oh my gosh, where did that go? You know. And the last little bit is to be cautious, because along with having a bigger paycheck than you ever had, there will be people that are interested in giving you loans. It will be quite easy for you to borrow money if you would like to do so. You have to be really cautious about that, because you could potentially if you are getting all these things, you could have the potential to dig yourself in a hole up front, and you don't want to do that. You want to be really thoughtful. If you want to get a loan, you have to think about, okay, how does this match my priorities? How is this going to work for me? What does this look like in my budget? What's my long-term plan for how I'm going to pay this off? And same thing with when you're buying a house, because, you know, if you are looking to borrow money to buy a house and you're looking for a mortgage, there will be people very ready to sell you more house than what you can afford, even with your salary. And you have to be cautious about listening to people, because if you're listening to people trying to sell you things, then you will sort of end up with a bigger debt than you really can sustain, because, you know, other people will be looking at your salary saying, oh, you know, 40%, you know, you can get a bigger loan than that. You can have more house, you can have, you know, whatever else. And you have to make sure, okay, is this something that I really want? Is that my biggest priority? Is this the right thing here? So just intention.
Yeah. Thank you for that. You want to say something, Tina? Oh, and then just kind of like looking in the chat, it seems like, yeah, Carmen mentioned about Digit as the other app that you can use to budget. I have heard of that one. And then Tina also talks about, especially as Dr. Marshall kind of mentioned, about the being in a transition period and how helpful it is that some residency programs do have moving stipends for relocating. So be sure to reach out to your programs and inquire about them. So that's great. And then also, yes, so the emergency fund, most financial advisors will say 3 to 6 months. As some people that may know me very well, my goal in life is to be able to have financial freedom where if I wanted to, I would not have to work. So some people will say, and this is not something that will be attainable when I still in residency, but yes, fire. I've talked to Tina about this. But some people will say that you should eventually work up towards about 16 to 18 months, because that's how long a crash market can last. So then it's like, if something crashes, you're good because you have all your money there. But eventually that would be my goal. So the other thing I wanted to mention is about online banks. So I think I started learning about online banks like a few years ago. And so I feel like a lot of us are very familiar with like Bank of America, Chase. I don't know what other banks, but there are a lot of online banks that offer higher interest on your savings. So typically, if you have like a Bank of America or a Chase savings account, you're only getting like 0.01 or 0.03% on your savings. And online banks actually offer more. Before the COVID crash in the stock market and things, it was up to 2%. Actually, which is a big jump from 0.03%. And now it's like gone down to 0.5, but it's still more than 0.03%. So that's just something to consider. So these are some that I personally use. There's a lot of them out there. Do your research. I think something I didn't include on here is nerdwallet.com. I really like them because you can use it to compare different financial institutions for different things. Like if you wanted to look into like 401ks, or you wanted to look into Roth or saving accounts or credit cards, they do a comparison. So that's really good. So just keep those things in mind, because I don't think we talk about that enough. Also, there's credit unions. So, you know, once you relocate, credit unions oftentimes will have better rates on different things. I'll talk about the credit union under the credit as well. And then the other thing is like considering money buckets. Some people may find it a little bit overwhelming to create different accounts for different purposes, but it's something that I've found really helpful because it keeps me in check that I can't spend. Like if you only have one saving account, you don't know what you're allocating it to. Maybe like mentally, or if you keep it separately. But I found it very helpful to have different savings account. Ally actually has it where you have one savings account, but you have buckets so that you can kind of like divide and say, okay, this money is for a car. This money is for a house that I'm going to be saving for, when I graduate. Or some people do buy houses in residency. And then, you have different buckets. So I think one thing I do want to mention here is important because as a first generation college graduate, I know that I will eventually, and I still sometimes have to help my family out. And there's this balance of feeling like, okay, I made it and I need to help everybody else. And I can't. And so I literally have a family emergency fund. And I've told my mom, I told my grandma, it's a limited amount of money. And so I put in money every month to make sure that if something happens, that they really need assistance, I can help them out. So one is also like a car. I have paid off my car, but I still put money in there in case I need to have repairs. I'm now trying to start like to save for a house. I only started that like maybe last year, where so that I can have a down payment. I have one that's a vacation one. I have one that's an emergency one, and then I have another for like academic stuff. I just made that one like last week. So just kind of figure out what you want, what is important for you, and that has to do with your priorities, right? So when you're kind of figuring it out, put in a little money bucket so that you don't go and digging into the pots of other goals. So that's something to consider. And then even on the app, sometimes they'll be able to track, like if you say, okay, I want to save for this in a year, they'll track and say like, okay, you have this amount of money in this account. And so you don't necessarily need to log into all your accounts. You could just use the app to help be put in there. Yeah. Yes, Tina knows me so well. I love vacations. All right. The other thing is if you are into couponing can sometimes be overwhelming, but I like to coupon on coupons. So this is what I do. I go to Rookatine and then I go to Groupon through Rookatine because Rookatine basically gives you like percentages or discounts off, but they send you checks. So you get money surprises like every 3 months or something, like a check in the mail. And oh, nice. I never heard of Retail Me Not. Thanks for sharing that, Andy. So it's like, okay, I'm already getting a discount because I'm using Groupon, but then I get more money in a check because I went through Rookatine to get to Groupon. So yeah, I like that. I Bought It is another ad where like you, yes, honey. Has honey ever worked for you, Carmen? Because I definitely have honey on there and it never works. Shin. And I just saw a commercial about Capital One shopping, something they have like this other one. And these are kind of like basically apps fit into your internet and it kind of basically monitors what you're buying and offers you suggestions on coupons. Okay, so honey has worked for some people. So that's good. I Bought It is another app that's kind of like couponing. You have to take a picture of your receipts. Sometimes you have to scan items, but it basically is by store. So they'll have certain coupons by store. And then for those, I think for me, when I was transitioning, some things to keep in mind as you're trying to maybe buy new furniture or what have you, or maybe even sell your own stuff, OfferUp was the best thing. Like literally, like once I found out where I was going, that was like the first thing I did. And I basically bought all my stuff, put it into a storage unit, and I was like ready. So I went on OfferUp and I sold some things also from OfferUp and then let go of some other ones. Facebook Marketplace, my uncle likes that a lot. And then always don't forget like your thrift stores. So I love thrift stores because you find good stuff for the low. Yeah. So any questions about that so far? Or additions from our other people?
Brian, you talked about savings accounts. How about checking?
Yes, checking accounts. I only have one, and I don't leave my money in checking account because it's not benefiting me. um, Go ahead, Andy.
I was going to say same here. That's how we do it as well. That's where all of our kind of month-to-month living expenses flow through, but everything else ends up in our online savings accounts. We also
Exactly.
and some others.
Yeah, high five. So I think that's a good point. Thanks for bringing that up, Andy. Is if you know what your budget is, like like your utilities and your rent, keeping that in your checking account. And as your because you know it's automatically going to be drawn out, so that's good. The other thing about I forgot to say about online savings account is it's hard to get your money. So this is another way for people that are kind of like what is it called? That spend, vicariously. It takes a couple of days for you to transfer your money out. So that'll prevent you from overspending if you're overspender. But it's important to have your checking account so that you can have your money easily accessible to just like write a check or to use a debit card. But if you have your monies that you know is going to come out every month, that's where you should keep it. And when you sign up for your residencies, you can usually, at least at our residency, but most employment places, not just residency, you can determine how much of your paycheck you want to go to whatever account. So that's something to also keep in mind.
Ryan, I don't think I understand what you guys are saying exactly about not keeping your money in the checking account. Because so I'm literal. I'm sorry. So
yeah. Andy, you want to explore that, answer that more?
Sure. So checking accounts typically are not going to pay you any interest. Savings accounts will. The biggest difference between the two is accessibility. A lot of savings accounts have rules in place. You can only have so many withdrawals per month. Usually it might be 3, it might be 5. Because a savings account, the reason they pay you interest is because the banks know that they're going to get to hold on to your money and they can, loan that out, invest it, do what they want to do with it. And so they pay part of that back to you. So checking accounts are more for moving money in and out. So if you know you're having to make regular payments for bills, for rent, for groceries, whatever, that's typically going to be something you want to have a checking account for. Also for ATMs, right? That's where you're going to be able to get cash out of. If you have savings accounts at Bank of America, Wells Fargo, Chase, TD, any of the big banks, you can pull money out there too, but you will be limited in how many times you can do that per month, usually. Does that make sense, Ashley?
Yeah, so basically you're saying don't just keep a high balance so that it looks like you have money to yourself. It's a trick, is basically what you're saying.
You got it.
And it is worth looking into. There are some new hybrid accounts that have slowly been popping up. One that we have with SoFi, it's called a money account, but it actually gives you checks as well, and it pays 0.25% interest. So in between that savings and that checking. So there are some new models coming out where you can get a little bit of both worlds if you look a little bit.
Andy, can you type that in the chat? Someone was asking about. The other thing is, yes, that is a good point because Aspiration, the way that I first got with them was they actually provided interest on the checking account. And I was like, oh, okay. And they no longer do it. But the reason why I have kept them is because the checking account, they do not charge you for international withdrawals, and they actually, when you get charged for international withdrawal, they reimburse you. So as you know, I love to travel and I don't want to spend extra money just to withdraw some money. And it basically also saves you money because you don't have to convert your money from like US to whatever, country you're visiting, because I can just take it out of the ATM machine. So that was another thing. So that's one reason why I keep them, even though they don't offer the interest on the checking account. The other thing that I think is important to also mention that Aspiration is good about, and I haven't really gotten really into it, I really support their mission, but they're really into sustainable investment. So they're really into like environment, like justice thing. So there's also this, emerging mindset of we should invest our money in things that are not so corporate or that is oil based or that supports unjust things. So that's also another reason, if you're really into that, Aspiration might be something to look into, or purposely searching for institutions that believe in that. As we all know what happened with like Bank of America and the gas line and all that stuff. So that's that. Any other questions? Good stuff, good stuff. Okay, loan repayment. I'm going to have to be honest. I don't know as much about loan repayment. I remember that I chose a plan. I watched some videos. I chose one. And there was a 6-month grace period where I didn't have to pay. And it was something that I did not think of as much because I don't have as many loans. So I will have to say that I don't know as much about it. I do pay like X amount of money per month after my grace period, and I just made it automatic. And if you do an automatic withdrawal, you save money that way too. I forgot what the benefit was, but it was just that you get to save money. So I would suggest doing that. Do you, Tina or Andy or Kara, have anything else to add about the loan repayments? I would just say watch lots of videos, talk to your office of financial aids now, because they will help you. My financial aid office at the med school was so helpful in trying to figure out what was the best repayment plan for me. And if you're married, it also kind of changes things a little bit too.
Yeah, I would echo that and say talk to the experts at your program when you get there, because there's going to be options from monthly payments to income-based repayments, depending on where your loans came from, if they're public or private. And for anybody who's considering trying to go the loan forgiveness route, where you work so many years in a particular field or area, that can be very, very tricky. And the actual rate of students getting those loans paid off is very low right now, just because of small little administrative miscues along the way. So you really have to just keep digging in as you go, unfortunately.
I would also say, so Andy and I have combined finances. I think it does affect your loan repayment if you file jointly or separately as well of what your like loan repayment and like the taxing that they do every year as well. So if anyone is in a situation where they have a partner or are planning on combining finances with another person, it would be worth it to talk to your like institution about a particular plan. Also know that, like I think Ryan mentioned earlier, there are a lot of financial advisors just waiting for you, like waiting for you to become an MD and then just like offering like quote unquote like free services. It's important to kind of, it's okay to like have talks and discuss things, but I think a lot of them kind of operate on a like good faith basis where you work with them and they have some type of relationship with you. It might be like a small fee or no fee while you're in residency, and then like later on when you make the big bucks, like hopefully you continue with their financial like advisory firm. But they can be a source of information too if you find that the the process of navigating that is really unruly as well.
I think that's a good point to bring up, Tina, about the financial advisors, because there's a lot of information about like what to look for in a financial advisor. And I feel like for most of us, they kind of do more of the, I'm going to invest in you now so that I can, you can utilize me as a service when you are attending, but also be careful about the products that they're offering you because they commission on the products. So I think some things that are particularly important to look up is that if you are going to go with this financial advisor, is that they have a serial 7 and a serial 66. And so there's different certifications that financial advisors have. And I think those are two that are particularly important. And then the other thing is asking what products that they offer, because what you will find is like some financial advisors only provide one product because they're associated with Washington Mutual or is Washington Mutual one of them? I don't know, but they may be associated with certain financial institutions, and therefore they are limited in what they can offer you, versus a financial advisor that has all access to all different types of products and is really looking for the product that best fits you. So I think that's questions to ask. The other thing I will say is that it's really important that you ask your financial advisor if you are so interested in financial education. And so I think that's something that's really important because you don't want to just give your money to somebody and have them just manage it. I think it's really important that you also understand how they're making decisions, and have them say, I want to be a student and I need to understand. And I found someone that really did that well and like would break down like how like he looks at stocks. And I've like learned how to look at stocks myself. And I was like, so being able to keep growing in that and not just giving your money for somebody else to manage, because that's how people get money missing and they don't know what happened. Questions about that? Alrighty. And then some people already started commenting about the credit. Yes, credit rewards. If there is no benefit to having your bills, automatically withdrawn. For instance, if the institution that you pay is not charging additional percent for using your credit card, I would say use your credit card. But I found that most places, particularly like rent and utilities, if you try to use your credit card, they're going to charge you like additional 1-2%. So don't do that. But everything else, charge with your credit card so you can get benefits. Don't leave free money. The only thing is you need to pay them on time. So don't have a revolving balance. And I typically would try to like pay it a week before it's due so that you can make sure that you get the statement closing date, which is actually the more important part of your statement closing date. And then also, you know that you always have access to your credit reports, and there's 3 bureaus and you get one from each one once a year. So, you can do it every 4 months where you check your credit, and just keep track of when you will be able to check it again, for that particular bureau. And then the thing that I was going to say about credit unions here is that there are going to be times where you may need a loan. Like I had leased my car when I was in med school. And so I decided to keep the car and I got a loan. And I went with a credit union because they had the cheapest interest. So yeah, don't leave the credit unions out. Thank you, Tina. She found all the information. The 3 credit bureaus are Experian, TransUnion, and Equifax. And then don't get sucked into buying their stuff too, because when you go on there, they try to suck you into buying stuff, and your credit report is free. Okay, so don't get sucked in.
You get one free credit report each year from each of those 3. So if you just space it out every few months, you can kind of stay on top. But be aware, your score at each of them might be a little bit different because not all of them get all the information for each of the credit accounts you may have opened, which can be frustrating sometimes. And other sites and services like Credit Karma and Free Credit Score, those have also become better and better about pretty much giving you a really good snapshot of where your credit is at any given time.
Yeah, I use Credit Karma and Credit Sesame a lot. All right. Any questions? Again, I think as it relates to credit cards, Nelly, nerdwallet.com might be a good place to compare places. Honestly, with the credit cards, what you will get the best bang for your buck is the sign-on bonus. So when they tell you, oh, if you spend this amount of money and you get this many points, so what I will say is, if you know that you're gonna have a big expense, like, I don't know, that's gonna come up, that would be a time to like see what promotions are happening for like that new credit card sign up. Like, you know that you are, don't like do it without knowing that you already need to spend that much amount of money. You know what I'm saying? So like, if I know that I automatically have to spend $2,000 to go on a trip, that might be the time that I decide, okay, is it worth me? And I literally sit and calculate and I say, okay, how much am I going to get from my current credit cards versus how much is there a promotion that if I spend $2,000, I can get 50 points from somewhere else. So I kind of balance that, and then just keeping in mind that you still need to at least charge it every few months or so that you can keep it active, because you don't want to just like get credit cards for the bonuses and then they close because it doesn't, keep your record of being able to keep credit and continue to pay off credit. So it's just something to be careful of. But it sounds like you guys are already up on the credit reward game from the comments. And then the last piece, which also will very much differ from person to person, because you want to make sure your bills are paid. You want to make that sure that you have at least an emergency fund, whatever you decide your goal is. And when I say your bills are paid, that includes your loan repayment. Then you can talk about investment and retiring. And people will decide to do this at different points in time. And, if you're like, this is just too much right now because you do kind of get overwhelmed with signing all the papers for residency, and you're just like, I don't know. It's okay to say, I'll come back to it later, and say, I'm not going to put anything in there and I'm going to reassess in a few months. But the biggest thing is that you should know the difference between the Roth IRA and a 401k or 403b. A 403b is basically a 401k, but it's at nonprofit organizations. And so I know a lot of people have heard them. Are there people that have questions about them? I can talk about what the differences are between them, but.
Yeah, I don't know what a Roth IRA is. So if you could explain that would be great. Thank you.
Okay. Yeah. So I'll go ahead and talk about the differences. So with the 401k, 403b, and there's another slide that will also kind of break it down. But basically, with the 401k, 403b, you sign a paper with your employer. Okay. And you say, I want to put in this amount of money into this retirement plan that they already kind of have set up. And basically they will pull money out of your check before it's taxed and put it into your investment account. Oftentimes employers will also match this. Some employers do not. Some employers match based on how well the company is doing. And so it depends. But one of the good things about doing a 401k or 403b, investing in that, is that when you do your taxes, it makes it look like you didn't make as much money. So your tax bracket can change. However, once you retire and you decide to use the retirement money, you will be taxed at that time. So it depends on what your tax bracket will be at that time. So you will get taxed either way. It's just that you don't get taxed on it to invest upfront. Okay. And then the other thing I would say about retirement funds in general that I did not know before is that you can actually take your money out only the amount of money that you invested. You cannot take out the money gained from the investment. Okay, so let's say I invested $5,000. Right at the end of the year, maybe I made like 6,000. If I'm in a crunch, let's say I didn't have an emergency fund, I don't have any money buckets, and I really need some money right now to help with whatever situation, you can pull that $5,000 out without getting penalized because that's how much you invested. But if you pulled out 5,500, that $500 was a gain, okay? And then you would tax and you can get penalized for that, okay? So that's something to keep in mind.
Sorry, Ryan.
The Roth.
Quick question. Is that true for traditional or only for Roth since we've paid taxes on
Yeah, it's with the Roth. Yeah. So that's something to keep in mind. So I'm going to go to the Roth. So yes, thanks for letting me know that. So what Andy is saying is that with the 401k, 403b, because you weren't taxed in the beginning, like while yes, you invested that money, you weren't taxed in the beginning. So Uncle Sam is definitely going to make sure they get their money. So they're going to tax you on it afterwards. Okay, if you tried to pull it out early, even though that's how much you invested to begin with the Roth IRA, basically you get your paycheck, right? And you decide, okay, I actually have an extra money left over and I want to invest this into a retirement account. And a Roth IRA is basically a retirement account where you invest your money after it's already been taxed, because once you get your paycheck, Uncle Sam has already taxed your money. And the benefit of this is that when you decide that you want to take money out, you won't be taxed. So it's like you get to enjoy the growth of your money without it being taxed when you take it out. The issue with both of these accounts, there are maximums on how much you can invest. So it's not like you can, if you had like $50,000, you can put all $50,000 in there to try to help your investments. They're limited and it changes every year. So I wouldn't say a number necessarily. I know for sure that the Roth IRA this year and last year was like $6,000 is the maximum that you can invest. I think the 401k and 403b is like closer to 19,000 or 20,000. I forgot what it is because I don't have one. So I don't know if you know Andy, but it changes every. Okay, 19,500. Great. So it changes every year. You can always like look it up on irs.gov and say what's the limit for this year. So one of the benefits of the Roth IRA is that you're investing, and once you take that money out, you don't get taxed on it. And as Andy mentioned, you can take out the money that you invested, okay, without being penalized. The only thing about the Roth IRA is that there is a income limit on it. So, and that also changes. So if you, and I don't even know what it is, so I'm not gonna like tell you a number, but once you become an attending, you won't be able to do a Roth IRA. Is basically the gist. So as a resident, you should, if you can, if it fits in your budget, if you paid yourself and you have an emergency fund and you make sure your bills are paid and your loans are paid and that you paid all your credits off and you have extra money lying around, and you decide that, a 401k or 403b was best for you, and that money was already set aside for you because it's going to be automated, and you still have extra money that you want to open up our Roth IRA on your own, then you can put the extra money there, okay? But just know that it won't be there forever. So you won't be able to benefit from having your money grow in an investment account tax-free, okay?
Oh, wait, Ryan, are you saying you would have to move it after when you finish becoming an attending, or you just lose that money? I'm confused.
Oh, I'm saying not that you will lose it and it doesn't go away. It's just that once you become attending, you will not be able to put money in any Roth IRA because you make too much money. So once you make too much money, basically Uncle Sam is saying, I want all your money. So once you start making it too much money, I want to get all your taxes. So basically with the Roth IRA, because your money is growing there tax-free because you paid the taxes when you got paid, right? And you basically took whatever take-home money you have, you decided to put into this investment account. They're not going to tax you twice. So your money grows in this investment account without taxes. Well, without being taxed when you pull it out. You were taxed when you got paid, sorry. But once you make too much money, you can no longer invest in a Roth IRA. So it's like during residency is the only time that you'll be able to do that because you're gonna make too much money.
In the chat, Ashley was saying.
Oh yeah, Ashley's smart.
So
yeah, which I won't get into because that requires like So Ashley is talking about backdoor Roth IRAs, which is a possibility to do, but it requires some workaround. Basically, you work to get your like Roth IRA pushed into, your 401k or your 403b pushed into Roth.
Can I just give one quick example between Roth and traditional? So let's say you have $2,000 to invest in a retirement account. If you put it in a traditional one next year, then you'll save $400 on taxes this year. And if that $2,000 grows to $50,000 by the time you retire, when you take that $50,000 out, you'll pay taxes on all $50,000 of it at the time that you take it out during retirement. Now, let's say you take that $2,000 and you put it in a Roth IRA, you'll have to pay that $400 in taxes this year on that money. But if it goes to $50,000, when you take that $50,000 out, the extra $48,000 that you made, you won't pay taxes on any of that. So if you've got that long-term perspective, you can end up saving and making a lot more money by the time that time comes around.
Yeah. And the important part of it is Roth, because there are traditional IRAs, but it's not the benefit of your money growing over time. And when you pull it out, you're not taxed.
So I just want to clarify, with a Roth IRA, we can contribute to it while we're in residency. We cannot contribute to it after we graduate or finish residency, but that money is still growing, correct?
Correct. Yeah.
Okay. Thanks.
And the reason why I say you can't contribute, like you may decide you may not want to be attending, I don't know, but it's all based on your income, and there's a maximum income. So and it changes every year. So that's why it's important to look, because if you make above that maximum, they say, oh, you can't invest in it anymore.
They're giving you a tax break, and the idea is that you're giving tax breaks to people who have lower incomes and not to people that have higher incomes, which makes sense. Bye, everybody. I apologize. I have to step away to another meeting.
Thanks, Kara. So I think one thing that I did not understand when I was investing in these retirement accounts is like, what happens to the money when it's inside the account? And so I think that's important to talk about. And basically, so you put your money into this 401k, or you put into a 403b, or you put into a Roth IRA. Once it's in there, you have to decide where you want it to go. So like you have to decide, okay, I want to buy this stock, or I want to buy this ETF, or I want to buy this index fund. So the money inside these accounts are getting distributed, or you're purchasing different stocks within it. However you decide to do that. Some people might do mutual funds. So I just want you to understand that basically these retirement accounts are investments into the stock market, and you or your financial advisor or whomever basically helps you to determine how you want to invest it. So that differs from account to account.
I'm sorry, I have another question.
Mm-hmm.
So I know there's sometimes what you mentioned, like the employer will match your 401k. Is that also the same with the Roth IRA? Do the employer sometimes match that or no?
No. And by employer match, I think it's important to know what that means, because I didn't really explain that. Basically the employer will say, if you invest this amount of money into your retirement account, we will give you, some people will say we will give you the equivalent of what you invest up to X amount of dollars. Or they may say we will give you 2% up to X amount of dollars. So it varies. And this is where it's going to become important that you really talk up to the human resource people to kind of ask about what is the actual benefit that they're offering. So like, for instance, at our clinic, it was like, they won't give you a match until you've been there for the first year. So for me, I was like, I'm not opening this account because there's no benefit for me, I felt. But some people may say, well, I want my taxes to look less. So it benefits me to invest into this retirement account because they're basically investing your money, whatever you tell them you want to invest, before you get your paycheck. So it makes your take home amount is going to be less. So it varies on your situation. And then afterwards, they did not match every month. It was based on how well the clinic was doing. And for me, that was too unpredictable. And I was like, well, I don't know. So that's a good question. Does that answer your question? You understand that?
Yes, thank you.
Okay.
Can I add a couple other points?
Yeah, of course. This is free reign for all. This is Annie's first time.
So with your retirement account investments, most, whether it's IRA or 401k or 403b, most places will also have some sort of money market option, which is essentially turns it into like a savings account interest rate. If you don't want to be as risky as stocks or bonds or ETFs and other funds, you can just leave it as basically cash and it'll pay you a 0.5% interest rate. It's possible, right? It's not very advantageous, but it's there. The other thing is, I know there was that question about if employers would match IRA contributions. IRAs are completely solely your own investment vehicle. They have no connection to your employer whatsoever. It's just you. You quit, you change jobs, you move somewhere else. It's still yours. You have it. You're the only one who has control over it. 403bs and 401ks are only available through your employer, and they're going to stick with that employer account until you no longer work for that company anymore. At that point, you can take all that and you can roll it into an IRA, either a traditional one or a Roth one, depending on what type of 403b or 401k you have. But it is stuck in that employer account until you're no longer working for that company again.
Yeah. The other thing that sometimes people use their Roth IRAs as another like savings mechanism too, in that, like, if you put in the 5,000, 6,000, the money that you put in, you can, like, maybe you're saving towards a house, like later on you can take out the amount that you put in, not the interest, but the money that you've put in, and use it as a down payment for a house later on, if you would like. So it's like kind of another rainy day fund in a way.
Oh, and one last thing. If you have traditional IRA, when you hit retirement age, they're going to require you to start taking money out when you hit a certain age because they want those tax dollars. Roths, there's no required, it's called a required minimum distribution. If you're like 70 years old and you're like, I want to keep this money growing for me, for my kids, for my grandkids, whatever, you can leave it in there and do what you want with it when you want with it. But traditional IRAs, eventually they're going to come after you and say, you have to take out this much every year and pay your taxes on it. So a little less freedom in the traditional route.
I know this is a lot, and it takes a lot of time to understand this information. Like, I've been watching like financial literacy like videos since third year of med school, just because I was interested in it. So what I recommend, and I'll talk about it on I think this next slide, of people that you can follow or get additional information, and it takes time to really understand it. So I don't want you all to feel like you have to get everything now. It's just kind of to introduce you to these things. And then, oh, I should have probably not put HSA. I should put health savings account. So some other things that you may hear when you are signing up for all the things for residency that they will offer is like a health savings account. And another one is is it a flexible spending account? Is that the other one? Yeah, a flexible spending account or a health savings account. And I'll start with the flexible savings account. So the flexible spending account, thank you. Flexible spending account is basically an account that you say, okay, I want to take out this amount of money from my paycheck every month so that I can have available to spend on health related things. Okay. So with the flexible spending account, sometimes it's limited, like how much you can do or the maximum or the minimum, whatever. I used this just my first year because I knew I needed dental work and I was not trying to pay a lump sum for all my dental work. So basically what you do is I said, okay, I got an estimate of how much my dental work was going to cost. So it was probably, let's say it was like $1,500. Okay. Rather than me putting $1,500 on a credit card, I was able to, with my employer, say, okay, I want my flexible savings account to be $1,500. And what they do is they give me a card that has $1,500 on it. And what they do is they take $1,500 divided by 12 out of my paycheck before I get it. So you are basically kind of like doing a payment plan so that you can have this money available to you at the time. So that's what the flexible spending account is. Again, I only got it because I knew that I had this expense that was coming. Some people that may have like chronic diseases or for whatever reason, or you can have it for that. You're gonna add something, Andres?
I was just going to say the benefit is that you don't pay taxes on that money that gets taken out of your paycheck for the account. If Ryan had paid $1,500, that would have been $1,500 after she'd made, $1,800, paid the taxes, whatever. So this is money that you're earning, but that's not taxed at all.
But you also don't want to get it and then you don't spend it.
Use it or lose it.
Yeah, so if you don't spend it, you lose the money. So that's why I said be very thoughtful and intentional about what you're using it for. So for me, I knew that I needed to get that dental work done. So that's how I did it. The healthcare savings account is a bit different, and a lot of people will use this actually in like retirement age as kind of like their personal insurance. Basically, the health savings account, again, it takes money from your paycheck before you are taxed, okay, before you ever see it, and you can tell them how much money you want to take out. So all of this is determined by you, okay? And basically, it goes into the health savings account, and basically, you can use that money for any health expense, okay? The difference is that money can grow. Okay, you literally can take that money and you can say, okay, I want to invest it in a stock or whatever. I haven't actually had one. I tried to open one, and I'll tell you why I can't open one. So you basically, that money can grow there. And let's say you create this health savings account and you decide not to use it until 5 years later. You allow that money to grow there. Remember, this money was taken out before it was taxed. So one is a tax benefit on your taxes, but it's also growing. Okay. And if you have, it could be even something as simple as like buying over-the-counter medication or vitamins or a co-payment plan, a co-payment that you needed to pay. And you basically can use this money using your receipts, okay? And this is also going to be very important because you need to keep those receipts, right? So you can use receipts that you had from after you've established your health savings plan. Let's say it's 5 years after you establish and you have receipts for a health-related cost from 2 years ago, you can use that receipt and get your money back from your health savings account, okay? But while your money has been in there, it has been growing, and some people will use this kind of as their personal like health insurance. But also they've made money off of the money. So the only thing about the health savings account is you can't get it unless you have a high deductible insurance, health insurance, which means that your deductible is high, and you pay a lot of out-of-pocket costs before your health insurance kicks in. So it's kind of like a balance. And also you may be somewhere where they don't even offer you a high deductible plan. So like we aren't offered a high deductible plan, which is why I couldn't open a health savings account, which I really wanted to, but I couldn't. So yes, health savings plans are not taxed at all. So again, not something I think is really important for you all, but just something you should be aware of, because they are gonna like, you know, you may be at a place where they offer a high deductible plan. They may ask you about, do you want a health savings account? Do you want a flexible spending account? So it's just something you should be aware of as you're in this transition period. Questions? I'll move on to the next thing. Okay, so this is a Excel sheet of my finances during my first year of residency. It's only from June to December, but basically it's kind of how I set up mine. Basically at the top I have, okay, what is my income and what are my expenses? And there are fixed expenses and then there are variable expenses. Fixed expenses are expenses that you know is going to cost the same every month. Your rent, your car payment, your car insurance. I pay for Hulu, my phone bill, like all of those, that's not going to change, right? So I basically put the fixed expenses on top, and then I have variable expenses at the bottom. I'm not really good at really keeping track of any of my variable expenses, which is bad. But what I want you to see is that savings is one of my fixed expenses. I pay myself first. I make sure that, okay, I have $300 every month going to my emergency fund. It's automatic. Okay, it's automated. Sorry, automated. I made it automated, so I don't have to think about it. It's already happening. At one point, I did have like a joint account with my husband where we had a savings account, but we don't do our financials together. So that was one. But of course, you see, I didn't really put anything in there. It was like kind of like if I get a lump sum, I put something in there. Then I have my family emergency fund. I had my car fund, and I had a savings fund, and then I had a home fund. So these things would change, you know, based on, you know, if I got extra money or if my priorities change. And so my priorities did change over time. And so I kind of like, you know, now I don't put as much into my emergency fund because I've built it up a little bit. And now I've been putting it more into home as I'm thinking about graduating and purchasing a home. So these things change over time. So it's really important that you kind of reevaluate what your priorities are with time. And so then you have your income and expenses, and then what the difference is basically what you have left over either to invest or spend however you wish. So as you can see, like even with my fixed expenses, I still had like $800 something depending on the month. So just a visual, everyone is going to look different. So that's one. Any questions about this? Oh, there's another thing on here that I did not talk about, disability insurance. That's another thing that you will be asked about is disability insurance. There is short-term disability and there is long-term disability. I have neither, which is bad. But one reason why, well, I technically have one. I have a long-term disability insurance because our residency provides it to us. But the other is I don't have short-term disability because it costs extra money. And I felt that I had enough money in my emergency fund to basically cover my disability, short-term disability if I needed it. So that's what I got out of that one. Tina, Andrew, you have anything to add about that?
So I'm in the process of like talking to an advisor about disability insurance. I guess one counterpoint that I can potentially say is that if you get it starting now, usually you don't have to now being in residency, you don't have to like do a new medical evaluation. You can keep the same plan indefinitely. The cost has changed in intended, but it really is just based on everyone like your own unique situation. So there's a lot of nuances to it. I think there are pros and cons. Like I think wherever you go, there will be some form of like a very basic long-term disability plan by your employer. Um, but if you got a separate disability insurance policy, it would follow you wherever you went and kind of fill in the gaps of whatever your employer doesn't cover. um, so it is an extra expense though to think about, kind of like thinking about like, oh, like this is like another car insurance or another thing, like expense for the year. And it does kind of get into the weeds a little bit, but it's something maybe potentially worth thinking about, especially if you're in the situation where you're going to be the primary breadwinner in your family unit, or like potentially like, I think it's kind of a lot of like catastrophic thinking of like, oh, what if you get really sick and you can't do your job. The idea is that it would help cover you and pay you the same amount as if to a guaranteed amount to do not be able to do your own job. So there's a lot of details to it, but worth thinking about. But I think to Ryan's point, making sure that you have a healthy savings portfolio and then just being able to cover all your other expenses first is important. But would be worth like whenever HR kind of does your intake at the beginning of residency, just asking what their disability insurance policy is like. And then the other thing is, depending on which state you're practicing in as well, the leave policy can be different. Like for example, in Massachusetts, um, they're like after a certain number of days, it is paid, like family leave or sick leave, and so that can vary per state as well.
Thanks for that. The other thing I just thought about is about loan repayments is that people should look into different ways of doing loan repayment to benefit them, because usually when you do your loan payment, it's going to interest first and then like your principal later. So what some people will do is that they will pay their loan twice in a month so that the second payment goes more to the principal. I don't do that, but I've definitely like watched videos about how people do that. So it's just something else I wanted to mention so that you're aware of it and you can look it up for yourself. And then I think this is still like fixed expenses. And so like I had a Roth IRA and then I eventually created like taxable investment accounts because I just had extra money. But this is also in the bottom, like a breakdown of the medical insurance. Obviously I did not count this into my budget because this is paid before I haven't seen my account, but I just wanted to keep in my mind like how much money I had been paying for it before I even see my my check. So again, I want to mention that this is for 2 people. So I pay health insurance for myself and my husband. So like if you're single or your partner has their own insurance, this might be a little less. So your take home money would be more. So like say you are a single person, let's say it was half of this, you would be able to take at least $150 more home. So it's just to give you guys an idea of kind of like what some of this stuff costs. But again, these expenses were not included in my in like my fixed income because it's taken out before you even see your check. And then as I mentioned, I had the FSA beforehand, just on the first year. So these are some suggestions of like approaches that you can do to, be financially healthy. So there are different approaches. No one approach works well. I hear a lot about Dave Ramsey. I don't follow him, so I don't know. But somebody that I asked about, like, what's helped you with your financial, uh, you know, goals? This is something that they suggested. It's a nice diagram, but something to consider. And then this is another one. Yeah, some people are saying it's really good when you get started because $1,000 could be pretty easy to get, at least for your emergency funds, um, your initial emergency fund. And then the other thing, like people don't know what debt snowballing is. You guys want to explain what that is? Some people do like avalanche and snowball. I don't really know because I don't have credit debt like that.
If you have multiple debts that you're trying to pay off, say you have some credit card debt, an auto loan, student loan, and you're just kind of struggling to organize yourself around that, the debt snowball method means you take whatever the lowest dollar amount loan is. So let's say it's $500 in credit, and you just, all your extra money that you have, you attack that loan. Once you paid off, now you move it to the next one. So you're just snowballing from lowest to highest. Other advisors will say, go after the one with the largest interest rate, right? Because that's money on. Also perfectly reasonable. These are just ways to help you focus on a plan to get those debts paid off.
Thanks. And then this is another approach that someone had shared with me about how to kind of like invest your money in a tax efficient way. And so this is very focused on making sure that you're paying less taxes now. So again, this might be a different approach that works for some people. So, as we mentioned, if you can invest into your 101k, your 401k, or your 403b, that brings your taxes down, especially if you have an employer that's matching your money. You would be leaving free money technically on the table, and then paying like your highest interest debt would be a thing, and then like the health savings account, which we talked about, has a tax benefit because it grows there without being taxed. It's taxed before you get your paycheck, and it's before your paycheck is taxed and all that stuff. So this is just another way. And these, like I said, these money limits are old because, like I said, the Roth IRA has changed to like 6,000. So yeah. So just gonna kind of open it up and ask people if they have questions. And I think that's it. Oh, and these were resources of some of the things that we talked about. I'll send it to the PowerPoint to Carmen so that she can email it out to you all. But these are just some people that like I follow. There's so many people like out there. Well, all of them I don't follow. The people I follow like Budgetnista, Our Rich Journey, sometimes White Coat Investor, sometimes Jazz Wealth Managers, and some other people on YouTube. And then, like I said, NerdWallet is really good for comparing different things. Like if you want to compare credit cards or you want to compare savings accounts, they have like all these comparisons. And then the other ones were kind of like mentioned by other people. So I think that's it. Any other questions that people have?
The other thing I'll just mention to it, and Ryan kind of alluded to this too, is that like this might be the first time for some folks where they're given this amount of money, and just be cognizant that like managing this can be a really emotional, like kind of mentally triggering thing, especially if you come from a background where there isn't a lot, or if there is this pressure to help support other people. Um, Something that might be helpful that I've heard, it's just making sure that you're kind to yourself. If there are ways to budget in little nice things to make, especially your intro year, really manageable, like if you are able to save a little bit, to get your house clean once a month, just to give yourself that peace of mind. Um, you know, Whatever people talk about lattes, but just treat yourself to a latte if you're having like a week, or like if you're on call every other day, like every other 3 days for a week or two. Like little things are um can be stressful. So definitely having a little bit of a fun just to treat yourself is really important, and really helpful during the year. And I think another thing is that you'll find that your fellow co-residents, like those who are a little bit like ahead of you, wherever you end up, might be a really valuable resource too, because they'll know um, like how much rent is, and how much, like it would might be worth it just to reach out to current residents right now and see, like, like how much are you budgeting on rent, how much are you budgeting on certain things, like what is the cost of living, like if you're moving from an area that the cost of living is very different from where you are currently, um, then it would might be helpful to reach out. Sometimes, like, meal prep, or other things, like anything that will help give you a little bit of time so that you can rest is also really important. But yeah, it's an exciting time, and it does really feel good. I think after a long, long time of paying other people for things, to be able to feel like you're getting paid a little bit for your effort. So all is up.
Definitely. Thank you so much for that addition. I think that's so important because I have like had someone come and clean my house a couple of times, and it's so amazing just to like leave work, and then all of a sudden it's like magic. You just come home and your house is clean. And I initially like had feelings about it, like, oh, only rich people do that, or like, man, I should really be able to clean my own house, like, but really being gentle with yourself, and don't feel that you need to budget all your money to just save, but you should really be enjoying your money as well. So I think that's so important to also include in there. Any other questions? And then also the last point at the end of this resource is a book that I just started reading, but I just wanted to put that in there. Don't read this like right now. Like read it like, a year or two before you graduate residency, because which I guess for some people that are in 3-year programs, that's technically next year. But but I think it's so important that we really understand our money, and that we, especially as family med doctors, we learn how to negotiate for more money. So I think it's just a good resource to have. But don't read it now. We'll keep people a few more minutes to ask questions if they have any. But feel free to log off. And like I said, we'll be sure to send out the PowerPoint and the video.
Thank you guys so much. This is really, really helpful.
You're welcome. I should stop the recording.